Welcome to Inside Economics. I'm Mark Zaney, the chief economist of Moody's Analytics, and I'm joined by three of my colleagues, which is tradition on Jobs Friday. This is Friday, March the 10th, and we got the jobs numbers for February today. And that would include Mr. DeRides. Chris, Dr. DeRides, how are you?
Doing well. How are you doing, Mark?
I'm okay. And Miss Dina Talley.
Hello.
How are you?
I'm great. How are you?
And Mr. DeAntonio, how are you?
Doing well, as always.
Oh, I always
All
say
these
this.
Italian last
That's
name.
what I was going to say.
The three Ds.
The three Ds. Yeah. Well, very good. And well, we made our way back from Phoenix, right? We had the summit. How'd you guys think it went? What do you think?
I thought it was great.
It was, yeah,
Yeah. Would you say
was-
otherwise? You would never say otherwise. Oh, that was awful.
probably not.
Probably not.
I'm unvarnished. I would tell you the truth.
Okay.
No,
Well,
you
that's good to
wouldn't.
know. I certainly wouldn't have said the truth. No way. It's fabulous. It was fabulous. No, it actually was pretty good, I thought. I thought it went very well. Marissa, how was your sessions? Okay.
Yeah, it was good. It was pretty well attended. Chris
Yep.
helped moderate it. And it was really interesting. We had Ronnie Moman from Lending Club. So it was nice to have sort of a fintech voice there. Yeah, it was really good. We talked about household finances, which is what we talked about on the last podcast.
Yeah.
Yeah.
And we had our own podcast there, right? We recorded a podcast session. Is that going to go up on Apple and Spotify and everything else? Does anyone know, or did we record it for that or not? It was just special to the conference. Does anyone know?
I
Sarah,
don't. I was wondering the same thing.
Is that
I don't
going up,
know.
Sarah? Sarah runs the show here. Sarah, does that go up?
It will take a week before we get it back, and we'll.
Oh,
be
but it
able
is
to
going
post
up
it
on
then.
Spotify and Apple and everything.
If you approve, we'll put it up.
Okay. Yeah, I think we should. I think it was I don't know if I call it a classic, but it was quasi-classic. Yeah. Good.
We broke
All right,
new
we're going
ground.
to what's that, Chris?
We broke new ground, right, with the live studio audience.
Yeah. If I were going to do it again, I have some ideas about how I would change it, though.
Yeah.
Yeah. Because we were a little removed, felt physically
Yeah.
removed from our audience, and we needed to be with our audience. So
Even
next
from
time
each
we're gonna
other. Right.
Yeah. And with each other, we were
Yeah,
very
we-
far apart on the stage.
we'll be in the round. We need to do it in the round.
Yeah.
You know what I'm
Yeah.
saying? Yeah. With cameras and everything. Yeah. That's Mr. DeAntonio. That's
Snickering.
snickering's the
I
word.
just wish I could have been there to see it. It sounds
yeah.
like a great time.
Yeah, it was good. Hey, we got to do two things in this podcast. Number one is the jobs numbers. We got to go through that, but we also need to talk about this failure of Silicon Valley Bank, SVB, which is causing a bit of agita in markets today. So what should we do first, guys? The jobs numbers or SVB? Dante, what do you say?
I'll always
Your
vote jobs.
Always vote jobs. Okay, we're doing jobs first. So we'll do the jobs. We're going to go through those numbers. And by the way, I think that those numbers are right down the strike zone. I'm just saying. Inside
To
joke.
script.
Inside joke. Stuck to script. Yeah, inside joke.
Exactly. The script.
Yeah, but let's talk about that. And then we'll do the game, the statistics game, and then we'll come back and talk about SVB, Silicon Valley Bank, and its failure and what it means. Okay, Dante, you're up. Give us a rundown on the jobs numbers for February of 2023.
Sure. So we got another, I would call it strong jobs report for February. We added 311,000 jobs. 3-month moving average is now just over 350,000, which is up from a little over 280,000 at the end of the year. Pretty broad-based gains across industries. There were a couple pockets of weakness. Transportation and warehousing, manufacturing declined for the first time in quite a while. Information was down again for the third month in a row, which tech-related layoffs obviously having an impact there. But also some, I think, good news if you're thinking about maybe a little bit of softening in the labor markets. Average hours came down a little bit. Average hourly earnings was a little bit softer than I think we were expecting it to be, given the strength of the labor market recently. The unemployment rate ticked a little bit higher, back up to 3.6%, because labor force growth was very strong. We added over 400,000 people to the labor force in February. Labor force participation edged higher to its highest rate for the cycle at 62.5%. prime EPOP, the employment to population ratio, hit back to its February 2020 level again, the highest that it's been
Oh, I didn't
in
see
this
that.
cycle. So I think, all in all, like you said, it was a good report. It was, if anything, I think maybe bordering on stronger than we'd want it to be, but certainly I think a better read than January, not as sort of overly strong as what we saw last month.
Okay, so obviously labor demand still very strong, 311K. I saw some downward revisions, small downward revisions to the gain in January and December, but still strong demand. 300K plus on a 3-month moving average basis, as you say. But the good news is more labor supply, right? We got increased labor force participation, and as you say, labor force increased by over 400K, and that's why the unemployment rate notched a bit higher. So we were at 3.4%, I think as low as it's been since 1969 in January, and now we're back up to 3.6. Although I didn't look, employment to population ratio for prime age workers 25 to 54, which is another good measure of slack in the labor market, that rose to a new high this cycle.
Yeah, it was up 0.3% to 80.5%.
Okay.
Which matches exactly what it was in February of 2020.
Oh, if I go back prior to the pandemic,
Right.
Now we're back to where we were prior to the pandemic. So,
Correct.
Okay. Which is that was also a pretty obviously tight labor market at that point in time.
Right.
Okay. And you mentioned wage growth. Do you want to average hourly earnings wage growth in the report? You want to provide any more granularity there on that number? Because that seemed to me seems to be an important number going, if you're thinking about it through the prism of the inflation, right? The cost of services, the price for services, which are labor intensive, goes to wage growth. So all eyes on wage growth. You want to just provide a little more granularity there?
Sure. A few ways to look at it. It was up 0.2% month over month, up 4.6% year over year. My guess is your preferred way to look at it will be the 3-month annualized rate, which is 3.6%, which seems to be right in that sort of sweet spot of where you'd want it to be. I do have a little bit of caution. I think maybe there could be some composition issues there that are sort of keeping it down a little bit in recent months. You've obviously seen some pullback in information, which is obviously a high wage industry, and you've seen big job gains in leisure and hospitality and in retail over the last few months. So I think there could be a little bit of compositional effect helping keep it lower than it maybe really is.
Yeah, your point is the average hourly earnings measure does not control for the mix of occupations or industries. So if you get, strong gains in lower paying industries like leisure, which we did in leisure, hospitality, and retail, that might bias down the number, but
Right.
but abstracting from that. Okay, can I ask before I move? I'm going to Marissa and Chris, I'm going to come to you next and kind of ask you to fill out this the storyline here, but on wage growth, do you, and let me just frame it this way. If I go back a year ago or so, wage growth was a lot stronger than it is today. Pick your measure, average hourly earnings, the employment cost index, the Atlanta Fed wage tracker. You looked at the plethora of data and you say, okay, wage growth is, over 5%, maybe as high as 5.5% year over year. I look at the data now, and it feels like it's closer to 4.5%. So we're not, maybe give or take, down about a point. And as you said, the kind of the benchmark where we need to go, or at least where we think we need to go to get inflation back in the bottle, is 3.5% wage growth, because that would be 2% inflation, the Fed's target, plus 1.5% underlying productivity growth, which is kind of the productivity growth we've been getting for the last few years, abstracting from the ups and downs in the data. Why do you think wage growth has come in by a point in that kind of stylized frame that I just articulated, when the labor market has been so strong, lots of jobs, continued low unemployment, EPOP, as you pointed out, is now at a new cyclical high. So the labor market has not eased by any meaningful measure that we look at, but wage growth has moderated. So what do you think is going on? How would you explain that?
I'm not sure that I have a good explanation for it, to be honest. I mean, yeah, it doesn't
I've
feel
got
like
one, by the way. I've got one.
I figured you had something in your
Yeah,
pocket.
but I'm
By
just
any
curious.
measure, like as you said, there's not any significant loosening in the labor market by any measure that we look at. So I don't know that there's a great sort of underlying story as to why we would have seen wage growth come in. Other than, I think obviously inflation has come in some. I think, maybe the sort of demands from workers have, eased off a little bit. We've seen the quit rate come in a little bit. Workers don't feel quite as comfortable jumping from job to job, which will take some pressure off of wage growth. So we have seen a little bit less movement, a little bit more uncertainty, I think, in the labor market, but it's still incredibly tight by pretty much any measure you look at.
Okay. Chris, Marissa, do you want to answer that? Do you have a view on that particular question before we move on back to the report on why wage growth has moderated over the past year despite continued very tight labor market conditions? Marissa, do you have a perspective?
Yeah, I think I agree with Dante. I mean, there is evidence that hiring.
Do you ever disagree with Mr. DeAntonio? Is this like an Italian thing going on here?
No, it's not an Italian thing.
That's okay.
What are you implying?
Exactly what it sounded like.
It's the three of us against you, Mark.
Exactly. You D's against the Z. Yeah. Go ahead.
So yeah, I mean, so there's some evidence that hiring has softened, that the quit rate has come down a little bit. I don't know that explains a full percentage point decline in wages. I think if you look back at the peak of where wage growth was, you can see that there's some industry composition factors going on. So initially coming out of the pandemic, the hiring was all these in-person things, right? It was restaurants and bars and entertainment and retail that were really struggling to convince workers to come back to those sorts of jobs. And they had to offer very, very high wages. Wage or employment levels in those industries are still, in leisure hospitality, it's still below where it was prior to the pandemic, but hiring has been very, very strong. And it doesn't seem like there's quite as much of a labor shortage as there was, back then. So I think some of that pressure to offer very, very high wages has come off the boil. I mean, if you look at wages in leisure hospitality, I think it was the summer of 21, wage growth was like 15% above where it had been, a year prior. And now that's back down to something that looks more average, like 5%. So I think some of it can be explained by just a broader base of hiring across different segments of the economy.
Yeah. Okay. So you what I took away is you're pushing back a little bit on my stylized fact of no easing in the labor market. And you're saying, oh, it has eased up a little bit, most notably through the quit rate. The number of people who are quitting their jobs, still a bit elevated, but it's definitely down from where it was a year ago. And that closely is correlated with wage growth because it's the switchers that people move in jobs where they get the big pay increases. So that makes perfect sense. Chris, do you have a pet theory as to what's going on here?
I would have pointed to the quits as well. The other aspect I can think of is compensation in a non-pecuniary ways, right? So people still preferring to have flexibility in their schedule, or give me Friday off, or some non-monetary incentive or benefit versus demanding a higher wage gain. But it's just a pet theory, right?
Yep.
I think there's definitely something to that. I mean, I know people that have been, looking for jobs and are willing to take less money if it means they can work from home 3 days a week and they don't have to go into an office. So I think that there is something to that, workers valuing non-monetary compensation.
Yeah, that's something we might want to try to test looking across industry, because different industries have different kind of remote work dynamics, and you can look at that compared to, what's happened with the wage growth in those industries. That might be something worth that. What about, remember when Bill Spriggs, the chief economist of the AFL-CIO, was on? He was talking about the minimum wage hikes across the country, that they've had some additional ones this January, but much less so than last January and the January before. Maybe that's taking a little pressure off. Does that resonate with anybody? We need to go investigate that a little bit.
It could, especially just given the industries, right? Because most minimum wage workers work in retail or leisure hospitality, which is where you saw this job growth and demand for labor too. So that could have been exacerbating that for sure.
Well, and I'm surprised no one took my pet theory. Maybe you guys don't buy into it, and that's inflation expectations. Yeah. I mean, inflation expectations took off this time last year when Russia invaded Ukraine, gas prices went north. And those workers' inflation expectations jumped. They, went to their employer and said, "Hey, you got to pay me more to get to work because inflation is going to be higher." But now with we're on the other side of the fallout from the Russian invasion, gas prices have come back down. People are less up in arms. You can see it in the inflation expectations data, and that's caused wage growth to moderate. Does that resonate with anybody?
Yeah, I think it fits into the story. I think it's certainly a piece of the puzzle. I think all of all the things we mentioned probably come together to give you that percentage point.
That percentage point. Okay. All right. Okay. Let's go back to the report. It was a little bit of a sidebar, and let me turn to you, Marissa, next. Anything that you want to fill in with regard to the story around the jobs numbers that you think Dante missed or you want to highlight?
One thing Dante and I were talking about before we started recording was the demographic composition of the household survey and what the increase in unemployment looks like across different groups. So I noted that over the past year, almost all the increase in unemployment has been among foreign-born workers as opposed to native-born workers. That means anybody who wasn't born in the United States, regardless of when they were born, right? So, I mean, it could be, doesn't necessarily mean it's a recent immigration. And it looks like a lot of the increase was among younger workers too this time, like the teen under 24, under 20 unemployment rate went higher. Also among Hispanics, it jumped quite a bit. And what else do I want to say? I mean, I think you noted
on
this,
that one on the foreign born that I've noticed, and correct me if I'm wrong, I didn't look today at today's numbers, but all of the increase or the vast bulk of the increase in the labor force since the pandemic hit has been among foreign born.
That's right. So that makes
where all the
sense
labor
why you would
supply
see
is.
you would see the increase in unemployment there.
Yeah.
And he noted I also was looking at the labor force flows, and there was an increase in the labor force last month of over 400,000, and more of those people went from out of the labor force into unemployment. I mean, they entered and they started looking for jobs, than people getting laid off, going from employed to unemployed. So it's a mix of people. Yes, some people, there is evidence that people lost jobs or were laid off. We see that in the duration of unemployment and the reasons for unemployment, but a lot of it was new supply into the labor force, which Dante noted with the EPOP ratio rising.
Got it. Chris, anything you want to add?
I looked at those demographics as well, and the one that stood out to me is that a disproportionate share of the new labor market entrants, the increase in the labor force that we're talking about, the 400,000 or so, came from folks with less than a high school education. So 350,000 people within that category entered the labor force. So that's consistent, at least with the narrative that it's really folks at the bottom end who are getting a lot of financial stress and maybe being forced to pick up another job or see how they can supplement their incomes.
Can you repeat that again? I missed that. So what age group has seen the biggest increase in labor force?
No, education, less than high school education.
Oh, less than high school. That's where the biggest increase in the labor force has been?
Last month. That's right.
Yeah.
Now there's some volatility there, so
Yeah,
you don't want to read in too much, but
yeah,
it just stuck
Right.
out.
So Chris, can I ask you, you're sitting at the Federal Reserve Board and you're making a decision around monetary policy, and you get this report, all else being equal, what kind of impact does this have on your thinking?
So interesting question. I think overall, this report, you can see what you want to see, right? It's a little bit of a Rorschach,
Right.
So you could justify a 50 basis point if you just looked at the top line and said, 311,000 jobs is still way too hot in terms of the labor market. Or you can justify 25 basis points because the wages seem to be coming in, even accounting for the compositional effects. So for me, right now I'm kind of in that second camp. I don't know that I need to be quite so aggressive because we do see some signs that there is some softening here going on. So I would go with the 25 basis point at this point.
Yeah, and I guess, and we'll come back to this, given what happened with Silicon Valley Bank and the angst now in the financials, and the stock market took it on the chin. And there's a lot of angst about the banking system, a lot of questions, which we definitely will come back in. But now, having seen that would probably push you to 25, right?
That's right.
Yeah.
That's on top of it. But if I'm just looking at the labor market report,
Yeah,
I-
that's
I-
what I
you
said.
know,
All else being equal.
Yeah.
Yeah.
And like I said, you could certainly make the case to be more aggressive, but I don't think it's needed at this point.
Yeah. Okay. That's my sense of it too. I mean, the 311,000 job gain is still too strong, right? I mean, I think a good rule of thumb is if you want to get unemployment kind of moving north a little bit, and I think we want some easing in the labor market. We want unemployment to get closer to 4 than 3.5. You need less than 100,000 jobs per month. So if underlying job growth is 300K, which is kind of sort of what it feels like, that's still way too much relative to, what we need, what I think we'd be looking at this point, to get to ease up the labor market and get it moving in the right direction. So to me, that does signal more rate hikes. But
Yeah.
then I look at the labor supply side. I look at labor supply, and that's actually pretty good. Labor force participation. I think we went to 62.5%, which is a new high since the pandemic hit. The peak before the pandemic was 63.3, so we're down 0.8%. But that now is pretty much what you would have expected if there had been no pandemic. So labor force participation is right where it should be. And we're getting more working age population. We were talking about foreign-born workers coming in, immigration has picked up. So if you look at labor force growth, it's about 200K per month. So, we're not, it's not, it could be the case that we could, if labor demand comes down to 200K, a little south of 200K, we could be okay. We could see some easing up in the labor market if this continues. And at least so far it continues. Here's the other thing on labor supply and labor demand that, has kind of been bothering me. And I'll throw it out there and see if anyone's got a kind of have a view on this, is how can one think the labor market's at full employment if we're creating consistently so many jobs, right? How is that possible? If you're at full employment, that means there's nobody out there to take a job, right? At the same time that wage growth is moderating. So doesn't the fact that we're creating 300K jobs per month mean we're not at full employment? What am I missing? You get my point?
Well, full employment's dynamic, right?
Yeah. Well, what does
Right.
that
So
mean?
you can keep adding. The goalpost keeps shifting, so you just
Right.
keep adding to satisfy it.
Yeah, but you get my point, though,
I
right?
do. Yeah.
You do. Dante or Marissa, do you have any insight on that? I mean, this is something that's been bothering me for a while. It just, how can those two things be true? How can you be at full employment and still generating so many jobs?
Yeah, I don't know that you can be. I think part of the answer to that is that maybe we're not at full employment, and I think that's your point, is that we're probably not there yet, even though it seems like by a lot of measures we are. But maybe the goalposts, as Chris said, have moved since the pandemic started, and we need to be at 3.2% unemployment to get to actually be full, or we need the prime EPOP ratio to be 80.8 to be full now, instead of what we used to think of as 80%. So maybe the goalposts have moved a little bit.
Or I'm not even arguing it's lower. Maybe it's not as high as people think. It's, most people think it's over 4, closer to 4.5. That doesn't feel right to me in that kind of. Here's the other possible explanation. The employment data is going to get revised down. We're not creating many of these jobs as we think we're creating. Right? I mean, that feels like even a more likely scenario.
Lots of questions about the data these days.
Yeah, right. The response rates and everything else,
seasonal
factors. So, makes me, the data just doesn't square. It never does, obviously. That's why Dante gets paid the big bucks trying to square that data. But yeah. Okay. Marissa, do you have any perspective on that?
Yeah, I think we might see revisions, and the household survey has not been as robust, generally speaking, as the payroll survey has been. So that might, even this report, yes, there was a big increase in the labor force, but you see maybe the absorption of people into the labor force is taking a little longer than it had been before. And so that would suggest that, yeah, maybe the payroll survey data are overstating a bit. I mean, and then your point about full employment, I mean, the unemployment rate if we go back prior to the pandemic, was also very, very low. And we're having the same conversations about what full
Yeah.
employment was, right? I
Mhm.
mean, we had an unemployment rate back then of 3.5%. We were saying, how are we still creating jobs? So I think it's very likely that we have to revise what we think full employment is. Demographics have changed. I think the pandemic probably kind of screwed things up in terms of who's available for work and who's still out. And, you know, it could very well be that there's more supply out there.
Yeah. Okay.
I mean, clearly there is, right?
Yeah.
Because
Yeah.
we see
Right.
it.
We see it. Right. Okay. Anything else on the jobs number that people want to bring up before we move on? Going, gone. Okay. You can always come back later whenever you want, but
Well, there's the stats game too, right? I don't want to give it away. Right?
oh, that's true. That's true. And I have a confession to make on the stats game.
You don't
I don't
have
have
one.
I don't have a stat. So
It's okay.
You could have just
There's
made
plenty
fun
to
of
talk
it.
about.
actually, I can come up with one while you guys are gabbing
Yeah,
away
I'm
here.
sure.
Yeah, while you guys are gabbing away. All right, let's play the stats game. The game is we each come up with a statistic. The others try to figure that out through questions, clues, deductive reasoning. The best question is one, or best statistic is one that is not so easy we get it immediately, not so hard we never get it, and is apropos to the topic at hand, which is jobs and also what's going on in the banking system today. So with that, this is now firmly tradition. We're going to begin with Marissa. What's your statistic?
Okay, my statistic, and this straddles both topics, I'll say, I
Ooh.
think.
That's a big hint.
Oh, wow.
It is a big hint. I shouldn't have said that. Okay.
No.
Well, all right, you might get this. Minus 54,000.
Jobs in
Finance.
Information job losses over the last 3 months.
information job
He
losses.
got it. He got it.
Yeah.
It was one of my
Yeah.
stats. that I'm gonna use.
What did you, that was your stat?
It was one of the ones I had on my list. Yeah. So
Yeah, that's a good one though. So you want to explain and
Yeah,
tell us the
so-
importance?
So the information sector, which includes a bunch of stuff, but it includes most of these tech companies, software publishing, kind of the traditional tech, but it also includes things like newspapers, online publications, the movie business. This has lost jobs for each of the last 3 months. So lost jobs in December, January, and February. We've been talking about why these tech layoffs haven't been showing up in the jobless claims data. They are showing up in the payroll survey. So over the past 3 months, the industry has lost 54,000 jobs since November. And you have to go back, if you abstract from the pandemic, you have to go back several years prior to the pandemic to get consecutive losses that were that big in the industry.
That's a good one. Very good. Okay. Dante, you're up.
I'll go to the second one. 56.
56.
56.
Is it related to jobs?
It is.
Is it in today's employment data?
Oh, is that the
How-
gain in retail employment?
No, I think that was about 50. Close, and this is
Oh.
not 1,000. It's just 56.
Yeah, that's what I was going to say. He hasn't stipulated
okay.
the units yet. I mean, usually you
Hmm.
say 56,000 if there's
Yeah,
that.
that
Would be really
pretty-
rude if
Yeah.
It's not 56,000.
It's 56. It's actually
It's
56.
56. Okay.
Correct.
Okay.
Is it in the household survey?
It is not. It's payroll
it-
survey.
It's in the payroll survey. 56.
Is it a
Is it
percentage?
the diffusion index?
It is an index. You're correct. Yeah.
It
it's
is
a
an
diffusion
index.
It's the employment diffusion index.
Yeah, for total private industries. Yeah.
Oh,
So I got it.
yeah.
Yeah. Ding, ding, ding,
Okay,
ding. Where's
all right.
where's that cowbell?
Nobody has a bell.
Yeah, we're kind of bellless this time. Very good. So you want to explain?
Yeah, so that's the lowest that it's been since April 2020, when obviously we had tons of job losses. The diffusion index measures the percentage of industries that are adding jobs. So that means that 56% of industries were adding jobs in February. Again, that's the lowest it's been in the first half of 2022. It was all the way up at 73. Even in the second half of 2022, it had come down a little bit, but it was still 65. So it certainly suggests that the strength of job growth, even though the headline number is still pretty strong, the strength of job growth, sort of the breadth of job growth is definitely diminishing. But I think certainly sets us up for a situation where we could see job growth slow pretty dramatically if you continue to see weakness broadening out across more industries.
Now that's an interesting statistic. That's a real sign of, I think, cooling off in the labor market, don't you think?
I think so.
Yeah. So it's 56, it's 56. And if it goes below 50, is that consistent with recession or not necessarily? What's consistent with recession? Do you know? Probably lower, probably around a third or something.
Yeah, I have to go back and look historically to
Yeah.
see. I mean, just because it's under 50 doesn't mean that you're losing
Yeah.
jobs necessarily.
Right.
Obviously, the size of the gain or loss is not factored in
Right.
there. But,
And how many
yeah.
industries are in is it I keep on saying 250, 300 industries that they provide data for?
Yeah,
Something like that.
It's several hundred industries in the
Several
total
hundred.
private
Okay.
one,
Yeah, that's a really good one. Can we keep track of that going forward? That's I think a pretty good window into what's going on in the labor market. Yeah.
Yep.
Okay. Okay. Very good. Chris, you're up.
All right, two related numbers.
Okay.
105,000 and negative 1.4%.
Are they in the job numbers?
They are. They're in the report. Yeah.
Payroll survey. Really?
Yeah. Yes.
Oh, he's not
yes,
sure.
Yes. Yes.
Yeah.
Oh.
Both are in the payroll
The
survey.
105,000, was that leisure hospitality job gains?
It is. It is.
Minus 1.4%. So is that related to leisure hospitality?
It is.
Is that wage
Is that the
growth?
slow in the wage growth?
Nope.
No. The hours
It's related
worked?
to leisure hospitality?
Hours worked.
Hours worked.
Weekly hours worked index, aggregate index of
Yeah.
weekly. Yes, that's it.
Yes,
Exactly what it said.
that's exactly what I meant. You got it.
You guessed your own statistic.
Yeah, that's so funny. Yeah. Oh, good. Well, okay. Well, you want to explain that one?
Yeah. So 105,000 people, right? Jobs added.
Yeah, that's a lot.
That's a lot. But in terms of the hours, the weekly hours, so you have the aggregate weekly hours, that actually declined.
Interesting.
Right. So you have more people, right, that have been hired, but the average work week is shorter for them. Right. So in
Right.
total, you actually have fewer hours in the leisure and hospitality industry.
Is
this
that a
month over last
trend
month.
in the industry, or is that just
It had been going up.
okay? So
Oh,
it could be just a
yes.
February data point, you think, or
It could be. It
Could
could be.
be.
But I really just
Yeah.
wanted to underscore that
the difference.
you got to look behind the numbers, because you might be hiring a lot of people, but they might be part-timers. Or,
Part-time.
Well, that's Dante mentioned this, but just to call out again, the other sign of a bit of weakness in the report was hours worked declined again.
right.
So that, that's a key statistic, both overall and in manufacturing. So, and that's a good leading indicator of historically of job growth. So if businesses generally cut hours back before they cut, jobs. And so that might be another indication that things are cooling off. Okay. I got a statistic. I lied. I got it on the fly here. It's actually a pretty good statistic, but it's going to be hard. I'm going to say 0. 0 is the number.
Was it in
Is it from the
today's
jobs
report?
report?
No, it's apropos to the next part of this conversation around
Okay.
Silicon Valley Bank. That's a big hint, by the way.
The share value of Silicon Valley Bank.
That's pretty good. I don't know if do you think it's exactly 0 right now?
No.
Yeah, probably could be. That's a good answer, but that wasn't what I had in mind.
Okay.
Yeah.
Is it a financial market statistic?
No, I'll give you one. I'll give you another statistic that very, very related that might help you with this. 4,700.
The market, S&P 500.
No,
No,
that's more.
That's
That
3,900 now.
Yeah, 3,900, maybe lower than that. Last I looked. Yeah. Yeah.
4,700.
What else can I tell you without giving it away? What happened to Silicon Valley Bank today?
It failed.
It failed.
It went into receivership of the FDIC.
Yes, that's another fancy way of saying it went kaput.
There was a
Yes.
run on it.
Yeah, there was a run. That's true too.
So is that the number of bank failures?
Oh, yes, great.
Since-
That's it. Exactly. Number of
Wait.
bank failures in
Until today.
2022, 0. Also 0 apparently in 2021. No bank failures in 2020.
But what's the 4,700?
What do you think that is? Bonus.
The number of banks.
Number of banks. Yeah, very good. Well, number of FDIC insured
Oh.
institutions, to be precise. Because Marissa's saying receivership, so 4,700. Zero. Isn't that fascinating? Yeah. And now I'm speaking from memory, but memory of about 5 minutes ago when I looked, but still memory. So I probably have it wrong. But I think in the teeth of the financial crisis, I think it was 2009, maybe 150 banks failed, to give context, something along those lines. Yeah. Okay. Let's now turn to Silicon Valley Bank. Of course, the other bank that failed, or I think it is failing, or they're winding it down, is Silvergate, right? That's the crypto bank, the bank that was lending to the crypto industry. I think it is winding down. I don't know if it's actually been put into receivership. Has it? I don't know. I don't know the answer to that question. Do you guys?
I don't know.
Okay.
I haven't seen that.
Doesn't matter. But we now have two. These aren't, I would call, big banks, but they're not small either. Yeah, they're not small.
Silicon Valley is 200 billion, right? That's
okay. Yeah, that's a big bank. 200 bank. That's a big bank. Yeah. All right, look, Chris, I'm going to turn to you. Maybe you can kind of summarize, what's going on here, and then the next question will be, well, what do you think it means? But what exactly is going on here in the case of SVB?
Yeah, so the bank failed earlier this week, right? They are undercapitalized. They are
failed today. It failed today, didn't it? On Friday?
Yeah, okay, but it was starting. They were
Yeah.
unable to successfully raise capital or over the last day or so, right? And that's what ultimately caused the failure. The I guess a couple of things went on here in terms of there is a run aspect to this. So depositors started getting concerned about their deposits and pulling them out, and that certainly hurt the financial position of the institution even more. The value, they had a lot of bonds on their balance sheet, and with the run up in interest rates, the value of those bonds has been marked down. So as they tried to sell those bonds, the value or the price was actually lower than what they paid, and that certainly hurt their capital position as well. So just in some sense, classic bank failure, in the sense they just were undercapitalized. But then I think what's unique about this institution is that they have a lot of exposure to, of course, the tech industry, a lot of venture capital, right? So they may have been taking collateral, shares in pre-IPO businesses, right? So they're really trying to facilitate or help the tech industry in a major way. They had a lot of exposure there, and with all the weakness that we're seeing in tech, that only snowballed into the broader weakness that they face today.
Yeah, can I take a crack at that, just because it's complex, and
Certainly.
let me put it in my words and tell me if this is consistent with what you said. So the problems really began a little over a year ago when the Fed started raising interest rates, and the value of tech stocks fell sharply. So if you go back January, February, March, April of last year, that's when the stock market went south, and that was led by a big decline in the stock of technology companies. And that goes to the fact that these are generally growth companies. Investors invest thinking that they're going to make money in the future, long into the future. So if interest rates rise, the present value of that future earnings is a lot lower. And so they get dinged, the valuations get dinged, very significantly. So they got marked down. So that made it difficult because the stock market's down, and that affects the ability of tech companies to raise capital, to go out and issue new debt, new equity, and new debt, right? Because they're now worth a lot less. So they can't raise as much cash. But you have got all these companies out there that are kind of, they're losing money. They have negative cash flow. They're burning through their cash, and that's drawing down. And a lot of these tech companies do business with Silicon Valley Bank. And they started drawing down the deposits that they held at the bank because they needed the cash to keep their business going and try to get across the finish line and produce something that that investors are invested in. As the deposits started to run off. And of course, there's already pressure for deposits to run off because rates are up and there's more competition for those deposits from other banks. And so there's runoff from that as well. But this puts pressure on Silicon Valley Bank to having to raise cash. They have to turn to the assets they own, which in this, they want to sell the most liquid assets, and that's treasury securities. I don't know if they held any mortgage securities, but treasury securities. But the problem there was the value of those treasury securities was now significantly lower because of the run up in rates. A lot of those treasury securities they invested in back when interest rates were very low. You know, think back a year and a half ago, we were at record low interest rates, but now those bonds are worth a lot less in this higher rate environment. So now they're having difficulty raising the cash they need to pay off the depositors. That's a classic kind of mismatch between assets and liabilities that banks often are struggling with. And then, of course, you know, you have depositors in those banks that are, particularly those that have deposits that are over 250,000, because then they don't have FDIC insurance, very sensitive to this. They get a whiff that there's an issue here and they start moving their money out of the bank. And then we get into the classic bank run. Everyone kind of Jimmy Stewart, Wonderful Life, running for the door. And the FDIC says, oh my gosh, I better shut the door shut before all the cash is gone. And so they shut the door and they said, okay, now we're just going to sort this out. The bank is now under receivership. They came up with another Bank of Santa Clara or something. They come up with a different name. Now for people with insured deposits, 250K or less, they're fine. They may have to wait till Monday to be able to get their money out. But if you had more than 250K in the bank, now you got to get in line with all the other creditors, the bank, the bondholders, and everybody else. And that gets sorted out, you know, in the process of receivership. Does that, I'm sure I repeated a lot of what you said, but just to repeat it because it is so complex. Did I get that roughly right, Chris? Does that narrative sound right to you?
Yeah.
Perfect. Okay. Perfect. Okay. Very good. Okay. Marissa, Dante, anything you want to add to, thinking around how we got into this, how Silicon Valley Bank got into this mess? Anything else to add?
I understand that they kind of took on the role as sort of almost like a venture capitalist in a lot of tech startups and tech, new tech companies in the area. And as you said, we've seen what's happened to the tech sector in the past year. So I guess my thinking about it is that it's sort of idiosyncratic to the kind of lending and the customer base that it had. I think the question that everyone will ask is this a sign of something more systemic in the banking system to come? It seems to me like perhaps this is not, and that it's idiosyncratic to the industry in which it was heavily invested in.
I was going to go there next, but before I
Yeah.
do, Dante, anything else to add?
No, go ahead.
No. Okay. Okay. Let's go back to that. So the obvious next question is, well, what does this mean? I mean, is this a fissure in the financial system? Is this a fault line in the financial system? Is this an earthquake that's coming? I mean, are we going to see a lot of banks get into trouble and we see a lot of bank failures? And your sense, Marissa, is no, that won't be the case. Why?
Yeah, tentatively no.
Yeah.
Because
Tentatively
of
no.
because
Tentatively
of
no?
just because of the nature, as I explained, of who they were lending to and the kinds of positions they appear to be taking. Somewhat different than your other traditional regional bank that has a broad-based portfolio lending to consumers and businesses and credit card lines, auto lines, mortgages. I'm sure Silicon Valley Bank had all those things as well, but they also took somewhat of almost like providing seed money to a lot of tech startups too, which I think is unique, which is why I'm not as worried about something more broad-based. And you had mentioned another bank that looks to be in trouble that was heavily invested in cryptocurrency.
Silvergate, yeah.
Yeah. So again, that seems a bit idiosyncratic and not truly representative of what most community or regional banks look like.
Yeah. Well, Chris, same view. What do you think?
Yeah, I would concur. At this point, it does look like it's the exposure to the tech industry itself, but I'd be a little cautious that the the valuation problem in terms of the assets, that could be universal, right? So you don't have a problem until you have a problem, right? In a lot of institutions. So if there was some other industry, for example, that started to show some signs of stress, and the banks serving that industry may very well experience a similar type of issue in terms of their asset base and what the true value of the securities that they're holding actually is, if they have to suddenly liquidate, right, and try to raise capital. So that would be the major concern I would have. That, yeah, I think in terms of the direct exposure to tech, I don't see many other banks in a similar situation, but there are banks that are very exposed to energy or very exposed to car manufacturing, right? So there could be some other areas if indeed we get into more of this rolling recession type of idea.
Right. I do worry about the very large security holdings the system has. I mean, I think in the wake of the financial crisis, one of the reforms was to have the banks hold more in securities, more treasury securities, more mortgage securities, Fannie Mae, Freddie Mac, Ginnie Mae, that are government-backed securities. The thinking being that they're more liquid, that, if a bank gets into trouble, that they could easily get cash to help them out if they had a lot of treasury and mortgage securities. And this is obviously, I guess, a potential problem with that strategy, is that, the value declines significantly in this world that we are just going through. I mean, if you go again back a year and a half ago, I think the 10-year treasury yield at one point was below 1%, right? So now it's 4%. That's a pretty big difference in a very short period of time. The one thing that gives me a little bit of solace there is that banks do need to stress test their balance sheets and their income statements to different interest rate scenarios. I mean, what I just articulated is not surprising. It's not news. And the banks have been required to, stress against different interest rate assumptions. So it feels like the system should be able to, kind of digest this. It's not great, but it should be able to digest this without this becoming a bigger issue. Here's the other thing that I think might be useful. Just, I'm going to throw it out there. It's a bit of a non sequitur, but I think important. The one sort of institution out there that can really help with this is the Federal Home Loan Bank system, right? The Federal Home Loan Banks were put on the planet back in the 30s to try to help banks with their liquidity issues. The banks can use their securities on their balance sheet, particularly mortgage securities, to provide collateral to get so-called advances from the Federal Home Loan Bank to liquidity, through tough times like this. And that should be helpful here. You can see advances by the Federal Home Loan Bank have picked up quite meaningfully here over the last 6-9 months, and that should help to support the system. But I agree with you. I think at this point it feels like this is more, as you said, Marissa, idiosyncratic, something related back to the tech industry. What about, though, if interest rates, I guess it's a question of how high rates go, right, and how long they stay there. So this gets back to monetary policy. Do you think that now that we're starting to see some more stresses developing here in the system, that this might be a reason why the Fed might not raise rates as much and keep them as high as long as they would, or what does that mean exactly? Chris, you have a view on that?
It's got to figure into the calculus, right? Because they don't want it's the cutting your nose to spite your face, right? If you raise rates so much, yeah, you might get inflation down, but then you've introduced all sorts of other financial system issues that the Fed is responsible for as well. So I think it certainly has to enter the calculus. I don't know that this event alone, right, takes precedent now and, they call off the inflation fight, but I think that it certainly will be in the back of their minds. And if there is this decision, if they're on the precipice of, well, is it 25 or 50, right, kind of undecided, could go either way, this certainly would be perhaps an additional weight to take a pause here, maybe just take the 25 basis point hike versus the 50.
Yeah, I mean, this is part of financial conditions, is it not?
Yes,
right.
Absolutely.
So when the Fed makes a decision around interest rate policy, it has a so-called reaction function. It sets policy based on a number of variables. One obviously being inflation relative to its target, 2, inflation expectations, 3, the strength of the labor market, how close are we or are we not to full employment, this kind of unemployment rate, and then financial conditions, what's going on in the equity market, what's going on in the corporate bond market. And here, what's happening with the banking system would be kind of key to those financial conditions. So if banks are running into some trouble here and financial conditions are tightening, meaning they're tightening down on credit availability and raising interest rates on the loans that they're making, that would be a reason, all else being equal, given what's going on with inflation expectations, the labor market, for the Fed to be less aggressive in raising interest rates, raise rates less than otherwise would be the case, or perhaps not keep them there as long. So it would seem to suggest that, here's another thing they need to be considering when they're setting policy here, in the next couple of weeks when they meet again.
Along that lines, do you think the Fed should take into account the debt ceiling debate? If they see that there's no resolution coming, should they preemptively adjust their monetary policy?
I would. Yeah, I think it should be in their calculation in the following way. It might go to timing. If you're going to raise rates, we think the X date on the debt limit, this is based on really good work Bernard Yaros is doing, is mid-August, right? So things are really going to start getting tense, probably beginning around July 4th. Come back from July 4th, holiday, things are really going to get tense. And hopefully the Fed's finished with its rate increases at that point in time. And it doesn't try to raise rates, in that period, because I think it would be highly counterproductive. So yeah, I don't know that it affects the terminal rate, the highest rate that gets, or how long rates stay at the terminal rate, but certainly should affect the timing. I think if they want to get some, their rate increases, and let's get it done, March, May, and June, and that's the end of it for a while. So that'd be my thinking. What do you think?
Yeah, I think that has to be part of their calculus as well.
Yeah,
but it certainly gets a little sticky in terms of
right. Okay, let me ask you this. Of course, I might be pushing you too hard, but let me just ask anyway, because I push you all the time. So
I'm used to
what should I be watching to gauge whether what's going on here is idiosyncratic to SVB or something that is more systemic, broadening out, a problem that's broadening out across the banking system? What would you be watching?
I guess I would be looking at debt spreads, or, looking for market signals. How are investors reacting here? Right? Presumably they have more information about individual banks and are factoring that into their calculus. So
used to be the case, I would say, go look at the TED spread, LIBOR, remember LIBOR, the London Interbank offering rate versus 3-month treasury bills. There's no LIBOR anymore, right?
SOFR.
You got SOFR. No. So what would you look at if you're not looking at LIBOR? There's got to be something in, out there that you would look at, because SOFR doesn't have any. That's the substitute for LIBOR. LIBOR used to be the rate that banks would charge each other for borrowing and lending to each other. So if there was a lot of angst in the banking system and banks got nervous about lending to another bank, they'd say, you got to pay me a higher interest rate. So LIBOR rates would go up relative to the risk-free 3-month treasury bill. And that was like a pure read into kind of the angst in the system around these issues. But LIBOR was discontinued. You may remember back, there was a scandal around LIBOR fixing, because they came from dealers and they lied about LIBOR during the financial crisis. So the replacement is the so-called SOFR, the secured overnight funding rate. I think I got that right, SOFR, but there's no credit risk there, so it doesn't represent the same thing. Is there some other measure out there, Chris, that's similar to that we can look at?
I think of a single measure, or because the credit default swaps or EDFs, or right?
Yeah,
tell you the individual
expected default frequency that on the banks.
Yeah, the individual, but you're thinking more of an aggregate. Is there some
Yeah, I'm just not sure. I mean, it's something I hadn't thought about until just today when SVB failed.
Right.
What should I be looking at to gauge whether this is broadening out? Maybe we can work on that.
Good question. Yeah, I'll think about
it. I'm not sure what we should be looking at, but anyway. Okay. Anything else on that topic that anyone wants to bring up?
Yeah, I don't know if you saw how dramatically market expectations for what the Fed's going to do in a few weeks shifted today.
No,
I mean,
no, I didn't see
I
that.
assume
What
it's
did
a
they do?
combination of the jobs report and SVB, but it was a pretty dramatic shift. Yesterday it was about a 2/3 odds of a 50 basis point hike in a few weeks, and that shifted basically the other direction. Now there's about a 2/3 probability on a 25 basis
Ah,
point hike in a few weeks.
makes
So
sense.
it was a pretty dramatic one-day shift in what the market's expecting the Fed to do. And I don't imagine that comes just from the jobs report alone. I mean, that might have boosted a little bit, but
I was going to go to recession probabilities again in the context of all this. So let's do that quickly and then we'll call it a podcast. Let me begin with Marissa because she's always straddling the middle, 50-50. So Marissa, what's the probability? And I'm going to ask this question one last time and then I'm going to change it next time I ask it. But what is the probability of recession over the next 12 months?
Seems a bit higher now. A little worried, a little more worried than I've been. So
Compared to in Phoenix, because in Phoenix you were a little less worried.
right. So now I'm on the
Okay.
other side of 50.
Oh, you're on the other side of 50. Okay, but you're still at 50.
I'm still at 50 with risks to the upside
Risks to the upside.
or the downside, depending on how you.
And what bothered you the most, the job number or the SVB?
I think despite what I just said about it being idiosyncratic, that worries me in the context of we know that banks are generally, this is a difficult environment for banks with rising rates, right? So I think, to Chris's point, which I hadn't really thought about in that way, I mean, this could be emblematic of just stresses in other parts of the economy if they were to come and just banks struggling to get funding and financing. So, if we do go into a recession, I mean, we could see there could be more financial stress coming. I still think this is idiosyncratic, but I'm a little more worried than I was yesterday, for sure.
Reasonable. Dante?
I think I've been between 45 and 50
Yeah.
mostly. I would say I'd probably edge at 45. I feel like a little bit better. If anything, I think SVB is concerning, but I think you also might get the sort of weird benefit that maybe it has the Fed back off a little bit sooner than they would have
Yeah.
otherwise, which maybe
Interesting.
provides a little bit of upside.
Yeah.
So I'd go 45%.
Yeah, that's interesting. Chris?
I'm going to stick with 60.
Okay.
With the arrow pointing up. More nervous.
Because of SVB?
I guess both the job report and SVB.
And the jobs report, really? Oh, okay. Interesting. Okay.
Yeah, I worry there that the Fed will look mostly at the top line.
Top line, the 311,000 jobs. Yeah, it's
So, yeah.
interesting.
But let's see CPI next week. And
Yeah, see, obviously that's going to be really important. Yeah, really key. I'm still at 45% probability of recession in the next 12 months with the arrow pointing down and then pointing down because I thought the jobs numbers were on balance pretty positive that the labor market is easing up here. And wage growth is the bottom line. That for me is the key, and that moved definitively in the right direction, even with the measurement issues. And also SVB, I think that's got to play a role in their thinking. There's got to be some uncertainty with regard to what kind of pressures are developing in the securities portfolios of banks. If SVB got turned upside down and all around in its asset liability, management, it may very well be that in other institutions as well. So something to watch. So I'd say the arrow is pointing down at this point. But next time I ask, I'm going to ask for probability of recession in 2023 and then probability of recession in 2024. I think we need to.
All right.
We need to do that.
And it gets interesting.
Yeah, I think it's interesting. Yeah, very good. Okay, we're going to call it a podcast at this point. I think we covered a lot of ground, and looking forward to next week. But take care, everyone. Have a good weekend. Talk to you soon.